everyone, welcome back to the case study discussion video of SCMPE. Today we are going to discuss question number 43 in skill based questions. Okay, so basically I'll give the overview first as usual and then we'll move on to solution. The first it is a cycle manufacturing company. Okay, ABC Cycles Limited cycle manufacturing company which has two divisions, namely A and B. So this with respect to the transfer pricing area of the uh, syllabus. Okay, now Division A produces a bicycle frame while Division B assembles it. Okay, there is a market for sub-assembly and also for the final product. So either A can sell it fully in the market and B can also sell it fully in the market. Okay, each division is to be treated as profit center, which means they are responsible for both the revenue and the cost. That's why they will be responsible for the profit. The transfer price has been set for now as long-term average market price, long run average market price. The following data is available to us. Estimated selling price of the final product. I do the bicycle frame, I assemble in division B, and then if I sell, the selling price would be 3,000 per unit. The long run average market price is 2,000 per unit of the sub-assembly. Incremental cost of completing the sub-assembly in division B is 1,500 per unit. Incremental cost in division A is 1,200 per unit, which means cost of division A, what is it? 1,200. Okay, cost of division B, long run market price of the sub-assembly unit plus the incremental cost, 2,000 plus 1,500. It would be 3,500. And then what happens? What is the actual cost to the company? It would be 1,500 plus 1,200 is nothing but 2,700. This is the thing which you have to understand first. Okay, now let's answer the questions. Okay, first question: if a division A maximum capacity is 1,000 per month and sales to intermediate now is 800 units, should the 200 units be transferred to B on long-term average basis? Come in. See, what happens here is we have a capacity of 1,000 and 800 units are to be sold to the market. We have a market demand of 800 units. If I'm not going to sell anything to division B, then 200 will be idle units. Now we have an opportunity to sell it, so we will sell it. Okay, 200 units. So let's see. Okay, there are two options available. Sell at the sub-assembly stage. What is the cost? 2,000 per unit. Actual cost is 1,200. We earn a contribution of 800 per for all the 800 units. For the remaining 200 units, what I'm going to do? Sell at the final product stage 3,000, and the cost to the company will be 2,700, and the profit here would be, the contribution here would be 300. So if there is the only 800 units market demand, then the 200 units can be sold to the division B. Okay, then second question was that what would be the transfer price if manager of division B should be kept motivated? Substantiate your reason. See, if I'm going to transfer at long-term average market price, okay, then what happens is that for division A, it will be 300 contribution per unit, right? Sorry, it will be 2,000 minus 1,200. 2,000 minus 1,200. 800 will be the contribution. Correct. 800 would be the contribution for division A, even for selling to division B. But for division B, it will be showing a net loss of 500. How? It will be bringing the cost at 2,000 for sub-assembly product, and incremental cost is 1,500, but it can sell only at 3,000. So it will be 500 rupees loss. Net for division A, it is 800 profit. Division B, it is 500 loss. Net 300 is the company's profit. Okay. Will the division B manager will be more, because it is value assessing based on profit center. Its incentives are based on profit center, right? Performance valuation is based on profit center approach. That's why he will not be motivated to buy it from the division A. What happens is that here we should adapt dual transfer pricing approach. Which means I will record some transfer price. Other division will, selling division will record some transfer price. Receiving division will record some other transfer price. Here, what happens is that I being a selling division, that is division A, will record at long run average market price will be the selling price, but the cost in the other one's book will be the variable cost, that is marginal cost, incremental cost. Okay, because this approach, dual transfer price approach, works here because it is evaluated based on the profits. It is evaluated based on the profits. It is treated as a profit centered. So what happens now if I sell it as if it records with the variable cost? What happens? The same 300 will be the profit at the division B also, and he will also be eligible for the incentives. Okay, but what is the negative advantage? You have to state that also. What is the negative advantage? What is the impact dual transfer price approach? There is a wide number of numbers. There is a wide range of numbers. We may not know what is a perfect number, and and it happens that there could be a human errors. It could be lead to manipulation and human errors in the overall company records. Clear. Now let's move on to the third one. If outside market increases 1,000 units, should the division A continue transfer 200 units? No, it will not transfer because the outside market earns 100 but contribution as contribution, and but you earn only 300 as a contribution. But you have to write a one point here. If there is a enhancement in the quality which is being done by the, you can write this as a little bit, it's not in the books, okay? But see, SCMP is full of interpretation and your own conclusions, but you have to write it in a convincing manner to the examiner. That's what. Okay. So what can write here is, if sub assembly product is going to add quality to the final assembled product, if the case may be, so that would enhance the non-monetary, that would have non-monetary value addition, right? Which may be increasing my brand value or something like that. Okay. So which I may also charge premium prices if it is there is some opportunities. Also, if I'm going to purchase it from outside and then assemble, that may lead to lesser quality and that may diminish my brand reputation. That could be a case like this. You can also develop your own interpretations. Okay, but you have to justify. Like you did not write it will lead to loss of quality. No, you have to write because this may be obtained from outside. There may be some errors or some defects could be there that would lead to or loss in reputation. So that's how you have to justify it. Okay. So with this we have completed one for the day. Thank you so much. Stay tuned.